Imagine this. China's stacking gold like never before. Officially, over 2,300 tons worth, $250 billion, with whispers of way more hidden away. They're dumping US Treasuries at a record clip, slashing holdings to just $682 billion, the lowest since 2008. This isn't random. It's a powerhouse move that could squeeze the dollar hard while padding your pocket if you're smart. What if this gold rush is the dollar's undoing and your wealth's lifesaver? As an American, ignoring it could cost you big. Let's dive in. You'll walk away knowing China's gold game plan, how it pressures the dollar, and simple ways it could shield your savings in a shaky world. We'll break it. First, the hard facts on their hoard. Second, the timeline showing the shift. Third, parallels that hit the dollar. Fourth, 2026 risks and how gold saves wealth. But first, why is China swapping treasuries for gold like crazy? China's not playing small. Their official gold reserves hit 2,306 tons by end 2025, up 27 tons from 2024, making up 8.5% of their forex stash, per the World Gold Council. That's valued at about $253.84 billion as of August 2025, after adding 60,000 ounces that month, according to Yahoo Finance. Meanwhile, they've slashed US Treasury holdings to $756.4 billion in June 2025, down from $780.2 billion a year before, continuing a deliberate drop. Globally, central banks like China's are snapping up over 1,000 tons of gold yearly, with emerging markets leading as a shield against risks, says Van Eck reports. Unofficial tallies? Some estimate total holdings over 5,500 tons, more than double the reported 2,303.5 tons from Forbes. This shift from a $1.32 trillion Treasury peak in 2013 is sanctions-proofing, inspired by Russia's asset freezes, as noted in investing.com analysis. Why trade paper for metal now? It hedges against US moves. But how did this build up? This didn't happen overnight. Back in the early 2000s, China kicked off big gold buys for reserve variety, starting small. By 2013, US Treasury holdings topped $1.32 trillion. Then, 2022's Russia sanctions lit a fire. Central banks ramped up, China included. From 2023 to 2024, they added hundreds of tons, hitting 2,292 tons by Q1 2025, 6.5% of reserves, while treasuries hovered at $759 billion, per investing.com. March 2025. Gold got Basel III Tier 1 status, boosting its appeal. June 2025. Treasuries slid to $756.4 billion. August. Reserves at 74.02 million ounces, $253.84 billion value. November. Down to $682.6 billion treasuries, the 2008 low, while gold rose to 74.15 million ounces from IDN Financials. December. Official tally 2,306 tons after a 27-ton bump. ETFs doubled to 248 tons. Assets up 243% to $35 billion. World Gold Council data. Post-Russia, buying stayed strong despite prices. De-dollarization full steam. Quick recap. From minimal to massive, timed with global shocks. Who's behind it, and why the dollar threat? China's moves echo a bigger shift. Global central bank gold at 36,200 tons, worth $4 trillion in early 2026, topping $3.9 trillion in foreign US Treasuries, per Economic Times. USD payments still rule at 47% in 2025, but reserves dropped from 66% in 2003 to 47% in 2022, IMF data shows. BRICS, led by China, pushes alternatives, but yuan hits trust walls. Foreign US Treasury holdings? $9.355 trillion in November 2025. But China's slice fell over 10% that year, Reuters reports. This could jack US rates as buyers dip. Your loans and mortgages feel it. No weaponizing treasuries. Dumping hurts China too, says Reuters. But the shift reshapes finance. Sanctions-proof gold avoids dollar risks, Royal Mint notes. Central banks cut USD from 70% to under 60% over decades. Gradual to dodge chaos, Advantage Gold explains. Recap. Sanctions proofing rewires global money. Looking ahead, gold could hit $5,000 per ounce by fourth quarter 2026, driven by central buys like China's. Maybe $6,000 longer term, JP Morgan forecasts. No dollar death, but shocks drop reserves to 40%. Policy slips like tariffs speed it. No consensus on sudden crush. Risks. Higher US borrowing costs as China exits, weakening dollar gradually. Wealth save? Gold's a hedge. Physical assets sidestep counterparty dangers, unlike dollars. Diversify now. Gold ETFs or bars could preserve value as reserves shift. Central buying stays tough on prices. Question. Ready to protect your wealth? China's hoard signals dollar pressure. Diversify into gold for safety, turning their strategy into your shield. No full crush ahead, but smart moves preserve wealth in this shift. Like, subscribe for more finance insights. Comment your gold strategy below. Next, BRICS' next move against USD. Hit the bell.